Imagine an AI company telling investors it generated about $421 million in revenue in a single year. It was public on NASDAQ. It had gone through a SPAC merger just months before. It presented itself as a fast-growing artificial intelligence platform for education, healthcare, and enterprise learning. Then prosecutors alleged that at least 90% of that revenue was fabricated through sham customers, fake contracts, and circular money transfers. This was not just another failed AI startup. It was a company prosecutors say built an artificial revenue machine around the most powerful market story of the moment: artificial intelligence. iLearningEngines was a Maryland-based company that described itself as an AI-powered learning automation platform. Its pitch was simple and credible. Large organizations have huge amounts of internal knowledge, training material, compliance information, and operational data. iLearningEngines said its technology could turn that information into automated learning and workflow systems. That idea sounded credible because it matched exactly what the market wanted to hear in 2024. Artificial intelligence was no longer just a technology trend. It was an investment theme. Every company wanted to say it was using AI. Every investor wanted to find the next business that could turn AI hype into real revenue. iLearningEngines offered that story. And it was not presented as a small experimental startup. In April 2024, it went public through a merger with Arrowroot Acquisition Corp., a SPAC. A SPAC is a public shell company created to merge with a private company and take it public faster than a traditional IPO. For investors, it can make a young company look more established. For the company, it can create access to public market credibility, tradable shares, and new financing. After the merger, iLearningEngines traded on NASDAQ under the ticker AILA. According to prosecutors, by around June 2024, the company's market capitalization reached approximately $1.5 billion. That matters. A NASDAQ listing changes how a company is perceived. It is no longer just a private startup making ambitious claims. It becomes a public company with filings, auditors, investors, lenders, and market coverage. And for iLearningEngines, the trust was built around one central claim: the business was growing fast. The first reason iLearningEngines looked credible was timing. It went public during the AI boom when investors were already prepared to believe that artificial intelligence could transform almost every industry. If a company said it used AI to automate corporate learning, training, and knowledge systems, the idea did not sound strange. It sounded like the future. The second reason was the business model. Software companies can be extremely attractive to investors because they appear scalable. Build the platform once, sell it many times, and collect recurring revenue from customers. That type of model can justify a high valuation if the growth looks real. The third reason was the reported financial performance. iLearningEngines reported revenue of about $217.9 million in 2021, $309.2 million in 2022, and $420.6 million in 2023. That is a clean growth story, not chaotic, not uneven, not early-stage uncertainty. It looked like a company scaling quickly and consistently. And that is important because alleged fraud in public companies often does not begin with one impossible number. It begins with numbers that look just possible enough. Growth that looks aggressive, but not absurd. Margins that look impressive, but not impossible. Customer relationships that sound real, but are hard for outsiders to verify. For investors, iLearningEngines was not just selling software. It was selling proof that AI could already produce hundreds of millions of dollars in revenue. That made the numbers valuable. And according to prosecutors, that also made the numbers worth fabricating. According to the indictment, the alleged scheme ran from around January 2019 to April 2025. At the center were two executives, Puttugramam Harish Chidambaran, the founder and former CEO, and Syed Farhan Ali Farhan Naqvi, the former CFO. Both men have been charged. Neither has been convicted. Prosecutors allege that iLearningEngines did not simply overstate a few contracts or misclassify a few sales. They allege the company fabricated customer relationships and used sham contracts to make revenue appear real. The first step was the paper. According to prosecutors, iLearningEngines allegedly created contracts with purported customers. Some of these contracts were worth tens of millions of dollars per year. A contract is powerful because it creates the appearance of business. There is a customer name, there is a signature, there is a payment obligation, there is a document that can be shown to auditors, lenders, and investors. But a contract only proves that a document exists. It does not prove that a real customer bought a real product for a real business reason. According to the DOJ, some contracts were allegedly signed by iLearningEngines employees or family members posing as executives of supposed customers. In other cases, prosecutors say associates of company executives helped create the appearance of customer relationships. The second step was the customer image. Prosecutors allege that shell entities were made to look legitimate. That included information that could support the appearance of real customers, including websites and corporate identities. This is where the alleged scheme becomes more than accounting. It becomes theater. A fake customer cannot look fake. It needs a name. It needs documents. It needs emails. It may need a website. It needs enough surface detail that someone reviewing the transaction does not immediately stop. Then came the most important part: cash movement. Round tripping is simple once you see it. A company sends money out to another entity. That entity sends the money back to the company. The returning money is then presented as customer revenue. To an outsider, it may look like a customer paid the company. But if the money originally came from the company itself, then the economic reality is different. No independent customer paid for the product. The money moved in a circle. According to prosecutors, iLearningEngines allegedly used money from investors and lenders to fund these round-trip transfers. The DOJ says the aggregate value of alleged round-trip transactions exceeded $144 million. That is why round-tripping can be so dangerous in financial fraud cases. It can create two kinds of evidence at once. First, the contract creates the appearance of a sale. Second, the money movement creates the appearance of payment. Together, they can make alleged fake revenue look real. And once revenue looks real, other things become possible. The company can show growth. It can raise money. It can borrow money. It can support a public listing. It can present itself as a successful AI platform at exactly the moment investors are desperate to find one. According to Reuters, prosecutors alleged that at least 90% of iLearningEngines' reported 2023 revenue was fake. That is the central allegation. Not that one customer failed to pay, not that one contract was misunderstood, but that the company's reported revenue was, according to prosecutors, overwhelmingly artificial. One of the strangest parts of the iLearningEngines story was the role of the company's so-called technology partner. In its public filings, iLearningEngines described a major partner that provided services such as research and development, sales and marketing, implementation, and support. On its own, that is not automatically suspicious. Technology companies often use partners, but the scale of this relationship raised questions. For the 6 months ended June 30, 2024, iLearningEngines reported that the technology partner collected about $238,961 million. It also reported about $237,553 million in technology partner service costs. Those numbers were almost equal. Again, that does not prove fraud by itself. But it created an obvious question. Why was so much of the company's reported economics flowing through one opaque partner structure? For a public company selling itself as a fast-growing AI platform, that should have invited close scrutiny. The first major red flag was the technology partner itself. During the SEC review process, the SEC asked iLearningEngines whether its technology partner was a related party. That question matters. A related party transaction is a deal involving someone connected to the company, its executives, or insiders. Related party deals are not automatically improper, but they require careful disclosure because they can be used to move money in ways outside investors cannot easily understand. The company said the technology partner was not a related party and did not hold financial interests in iLearningEngines. Then, on August 29, 2024, Hindenburg Research published a report. Hindenburg claimed that nearly all of iLearningEngines' revenue and expenses in 2022 and 2023 were run through an undisclosed related party referred to as the technology partner. This needs careful framing. Hindenburg was a short seller. It disclosed that it was short iLearningEngines shares, meaning it had a financial interest in the stock falling. That does not make its claims false. It also does not make them proven. It means the report should be treated as a market catalyst and an allegation source, not as a court finding. But the market reaction was immediate. After the report, iLearningEngines' stock price fell by more than 50% in one day. The company initially pushed back. It said it believed the short seller report contained misleading statements, speculation, and innuendo. But the pressure did not stop. The board formed a special committee. The SEC Division of Enforcement issued a subpoena. And soon, the questions were no longer just coming from a short seller. They were coming from regulators, auditors, and the company's own governance process. The collapse came quickly. In November 2024, the company disclosed that prior audited and unaudited financial statements covering 2021, 2022, 2023, and parts of 2024 should no longer be relied upon. That phrase is devastating. It means investors can no longer trust financial statements the company had previously issued. For any public company, that is serious. For a company whose entire market story depended on rapid revenue growth, it was catastrophic. Then came the management shakeup. Farhan Naqvi was placed on administrative leave from his CFO role in November 2024. In December, Harish Chidambaran and several other senior executives were placed on administrative leave. Then came bankruptcy. November 2024, financial statements declared no longer reliable. December 20th, 2024, iLearningEngines files for Chapter 11 bankruptcy protection in Delaware. January 2, 2025, NASDAQ suspends trading of AILE shares. March 6, 2025, bankruptcy case converted from Chapter 11 to Chapter 7 liquidation. Chapter 11 is usually the reorganization chapter. It gives a company a chance to restructure and continue operating. But iLearningEngines did not stabilize. Chapter 7 means liquidation. At that point, the company was no longer trying to reorganize as a going concern. A trustee took control of the estate to recover whatever value remained. A company that had gone public in April 2024 was effectively out of NASDAQ less than 9 months later. For shareholders, it meant near total loss. The company that had been worth approximately $1.5 billion at its peak was essentially worth nothing by mid-2025. Bankruptcy filings showed equity holders facing complete loss as secured creditors, including East West Bank and Valley National Bank, had priority claims on remaining assets. For employees, it meant the end of the company entirely. By February 2025, all remaining staff were terminated after the company failed to secure financing. For investors who bought into the AI growth story, it meant watching that story become evidence in a federal investigation. AI platform, public listing, billion-dollar market value, non-reliance, bankruptcy, delisting, liquidation. That is the speed of the collapse. Then, in April 2026, federal prosecutors brought the criminal case. The indictment charged Chidambaran and Naqvi with a continuing financial crimes enterprise, securities fraud, wire fraud, and related conspiracies. According to the DOJ, the charges arose from an alleged years-long scheme to deceive investors and lenders by materially misrepresenting iLearningEngines' financial performance. The DOJ said Chidambaran was arrested in Potomac, Maryland, and Naqvi was arrested in San Jose, California. Prosecutors also said that if convicted on the continuing financial crimes enterprise charge, each defendant faces a mandatory minimum of 10 years in prison and a maximum of life. That is potential legal exposure. It is not a sentence. The DOJ also said Chidambaran received more than $500 million worth of common stock and about $12.5 million in restricted stock units before the collapse. The DOJ said Naqvi was awarded common stock worth about $11.2 million and that the company paid nearly $4.5 million in cash for tax liabilities related to his stock awards. Those are allegations and government claims. They have not been tested at trial. The iLearningEngines case is still an allegation, not a conviction. The defendants have not been found guilty. They are presumed innocent unless and until proven guilty in court. But the case raises a broader question that will matter far beyond one company. In the AI boom, what actually proves revenue is real. A pitch deck does not prove it. A contract does not prove it. A customer logo does not prove it. Even money moving through bank accounts may not prove it if the money is moving in a circle. The hard evidence is less exciting. Independent customers, verified payment flows, clear related party disclosures, audited cash receipts, products that real customers use for real reasons. AI makes a story easier to sell because it makes extraordinary growth feel possible. But financial statements still have to obey ordinary rules. Revenue is not real because a company calls itself an AI platform. Revenue is real when an independent customer pays real money for a real product. That is the question underneath this case. Not whether the intelligence was artificial, but whether the revenue was.